Congratulations, Rishi. You've met your target of halving inflation by the end of the year. So, inflation data out this morning, CPI out this morning, and we've seen actually a massive fall, even more than I thought. My prediction of 5.3% was wrong. It looks like in retrospect, I forgot to cater in the energy price cap in October coming into play. So I was looking on month to month. I was putting a little bit more on, other people more wrong, but that's cool. We were expecting this massive drop, maybe not quite as big as it was today. So what I want to do today is a bit of an ad hoc, I'm afraid, ad hoc going live, going through the data, is look at that CPI data, answer the question, have we beaten it? Are we over inflation? Are we now in free fall? We're going to see interest rates drop earlier than expected. What's this going to do to the property market? What's this going to do to the interest rate market? We're going to look through the actual underlying data and see what it actually says. Or are there gremlins in there as always? I see Keith saying the cycle will find a way to complete and on time, which I know, Keith, you said earlier this week. Look, here we go. So before I crack on, I am live, so please, if you can hear me and see me, give me a thumbs up, put something in the comments. If you're watching on the replay, please do put your own thoughts and comments as I ask questions. As we go through it, I'll come back and try and answer all of those as we can. I know we're getting lots more people on the lives, so it's difficult to get through all of the questions. If you are new to the channel, welcome to all new subscribers. Thank you so much. We hit 3,000 subscribers yesterday, which was my target after Monday's live. So obviously now we're going looking for 4,000 to 5,000 within the first year. So appreciate that. And if you are new to the live stream, what we do here is look at the data to understand what's going on behind the headlines to make us make better investment decisions, whether we are in business, whether in property, or just out there buying houses. So let's crack into it, team, and see what the data has given us this month. Now, if you haven't seen the headline, CPI has fallen to, what's the main CPI? Not CPIH, 4.6 for CPI. However, CPIH is the one that we really care about. That's this one here, and this is 4.7%. Okay, so we've gone down from 6.3 to 4.7, which is a 1.6% drop month on month in terms of not the month on month drop, but the annual rate. Okay, we'll look on month in a little bit. Why do we care about CPIH over CPI? Let me just quickly explain that one if you haven't seen these before. CPI is it's pretty much everything other than housing costs. However, CPIH includes housing costs, specifically owner-occupier housing costs. And that is important because if we are looking at the property market as a whole, as investors or indeed buying houses, we kind of care about what it costs to own a house right now, especially with high rent, high interest rates. So actually putting those owner-occupier housing costs in give us a more accurate reflection of where we are. Not 100% accurate, but a more accurate reflection. So we want to focus on the CPIH, okay? So on a monthly basis, so this is month on month, we saw a 0.1% rise in CPIH, which, you know, if you annualize that, is 1.2% over a year, is below the government's 2% target. So it's been a good month for that. The largest downwards contribution to the monthly change in both CPIH and CPI has come from housing and household services, which on the face of it sounds like, oh, great, housing costs are coming down, right? But included in housing and household services are the utility, the energy prices. So the reason for this massive drop-off, and it is a drop-off that we were always expecting, is CPIH figure, or CPI figure, is a rolling or trailing 12-month adjustment. So it's a rate of change over the last 12 months. So last October, we saw the massive spike in energy prices. Okay, we'll show a graph to illustrate this in a bit. That has now fallen out of the data set. So pretty much the majority of this big fall that we've seen that we were expecting, don't forget, is that data has fallen out. And as well as that data falling out, actually the price cap in October revised down. So we're seeing a month-on-month reduction, if you like, although it's not reduction, but reduction in energy between basically this month and last month, or, you know, the month that the data was looking at. So it's pretty much all driven by energy. What does this mean for looking at this going forward? Ultimately, we've now seen this big spike drop out of the data set. So I've said for some time, and if I just actually just find on the iPad what we were talking about, for a while. I can't find it on the iPad, so I'll just go back to the screen and we'll look at the actual data table here. You can see on this data table that in October 2022, CPI was 2% month on month, CPIH was 1.6% month on month up here. This was the thing we're talking about falling out. That has now fallen out of the data set. You can see in October, CPIH, October 23, we're now 0.1% month on month. That's a big drop from 1.6 to 0.1. And again, in CPI 2 to 0, right? Big drop down, which is why I've seen this big drop. But don't forget, we need to look at the next 3 months. So we're seeing over November, December, and January, so that's 22 into 23, 0.4, 0.4, minus 0.4. So CPIH over the next quarter is going to get a net 0.4% up drop out of the figure. So not a huge amount. So we need to understand what's going to be going on month for the next quarter. We'll get to that in a bit. Before we do that, let's carry on and look at the individual elements. Now, when we look at this graph, one of the big, I'm not going to say scary because that's over dramatizing it, right? One of the big things that stands out to me is this. Is that a black, I haven't got my glasses on so I can't see. Is that a black line at the bottom? That's the OOH, right? This is the thing that I really care about as a property investor, looking at what's going to be happening to the property market. Because this black line, OOH, is owner-occupier housing costs, right? This is what it's costing somebody to own a house. I'm not going to go deep into rental equivalency values, how this has worked out. Let's just keep it simple and go, for people who own homes, right, this is the cost line of them owning a home. So despite we see CPI and CPIH dropping down, we're now at this inflection point, this crossover point. Traders have this cross of death, don't they? I'm not going to say it's a cross of death, right? We see this over here. It's not the first time that OOH has been above CPI, CPIH. But what is worrying or what is concerning to me is the almost exponential increase, exponential growth of this OOH line, which means it's getting exponentially more expensive to own property right now. And the main reason for this, team, right, is because of the increase in interest rates, the increase in rental values, because we do use something called a rental equivalency value to calculate this OOH. And we know this is not over, right? Bailey himself said we are only halfway through feeling the effects of the current interest rate rises. So we've got another year and a half worth of this filtering into the system. We're still seeing 110,000 people every single month coming off cheap fixed rate debt, with an estimate of, and I showed this in previous live streams, I'm not going to go over it again now, how much this is going to increase in terms of household budget between now and the end of 2026 as the lag effect of people coming off cheap fixed rate debt sort of expires and people coming onto more expensive interest rates. So this OOH line, if you like, is due to continue to get more expensive. And if we look at the reality, so let's just take for a minute, CPI figures as a whole, which is your whole basket of goods. There's lots of things in this basket of goods which people don't have to be buying, okay? Luxury items, food, people need food, sorry. Furniture, lots of goods which people don't need to be buying. We'll get onto goods in a bit because goods has actually been deflationary this month when we look at the data. Lots of things people don't have to buy. What they do have to do is live and eat. So food costs is very pertinent, and your housing costs is very important, both rental and mortgage payments, okay? So when you look at the reality of what these costs, when they filter through, how they actually affect people, these costs are going to have a much more or a disproportionate effect on people's affordability versus the cost of a pair of high heels, right? Or, the cost of some random thing you can go and buy in a random supermarket somewhere which nobody actually needs. So it's important to understand the actual impact on the floor. If we are looking at affordability, which is one of the 3 triggers of full-on crash or property correction, this is very important. Now, of course, another thing that's important with affordability is interest rates. So, of course, inflation is coming and tumbling massively. We could see interest rates come down earlier. And that is something that might happen if they continue to tumble, which is why I made that mention about the next quarter, December, January, February. Are we going to see inflation continue to come down, or are we going to go into secondary effects inflation? Let's just have a talk about that very quickly, right? Because if we look at the American inflation chart or USA inflation chart, our cousins over the pond, we can see a very similar thing, right? This blue line is their inflation, okay? And it drops off massively. I would say we're pretty much, we have been following this, a few months out, maybe 6 months behind where the Americans are. You can see this huge drop off where we go from, sort of 4.9 down to 3. So that's 2% over 2 months. But then we hit this bottom, right? Hit this little bounce. We get this secondary inflation, which has been there for the last few months now over the pond. And only now is that starting to come down. If we look at ours, we can see similar thing. We've got this big drop off now. Are we going to see the same thing over the next quarter, that we're going to get this little bounce? And let's not forget, dropped off, bounce, coming down, they still have not started reducing interest rates, right? This actual, if you look at this, the headline, this is from today or yesterday, US stocks and bonds jump after inflation falls to 3.2%, because they're only now are they saying, cool, the Fed rate hiking is probably now over. And that is how many we got here? 1, 2, 3, 4. We've got another 4 inflation prints after they hit that bottom. So for me, it's going to be very important to see what happens over the next quarter before we start saying, boom, we're in free fall with inflation, we've solved it, and interest rates are going to be coming down earlier than expected, right? So at the moment, we have to work on the assumption, even if we work on the assumption that we've peaked at 5.25% base rate, that interest rates will stay high for longer until we see further confirmed direction of this over the next quarter. Okay, so that's something to bear in mind. Now let's go through some of these individual elements. In fact, before I go through some of the individual elements, because there are some things that I want to pull out of this, I'm going to hand over to my past self. And I'm going to ask for the only favor that I ever ask you on these live streams. If you can bear with me for 40 to 45 seconds, just to explain why I do this channel, my vision with this channel, and how you can help me with it. I'll see you in 45 seconds. For those of you who are regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat is actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better, and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income-producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Okay, if you are new to the channel, please do hit that subscribe button. Next target is 5,000 within a year of launching the channel, which would be absolutely fantastic. And we've got till basically the 1st of March next year to hit that. So I appreciate all those efforts. Okay, so look, let's dive back into it. Let's look at the individual elements and see what notable changes we've had in that over the last month. Some things effectively jump out here, okay? The first is clothing and footwear. Bizarrely, it's gone up. But again, look, clothing and footwear, yes, we have to wear clothing, but we don't have to be going out spending loads of money. Clothing and footwear is going up, which is interesting because all the rest of the goods are coming down. Housing and household services, minus 3% month on month. We know this for the reason of the utilities falling out. We'll look at this in a graphical format in a bit. Look, notable must be of which owner-occupier housing costs, which is 0.7% month on month. Okay, that is 8.4% annualized now if we look at owner-occupier housing costs, and going up exponentially. Alcohol and tobacco is coming down. It's potentially good for Christmas period. Food seems to, in some areas now, coming down, and certainly, the annual rate is coming down, but some are actually deflationary now. What else we got? Transport. Interestingly, this is an interesting one. I want to focus on transport. So we've talked a lot about the cost of Brent going up and that feeding in. Activity in the Middle East feeding into the price of Brent. We still see a minus 0.2% month on month for transport, and that is for something other than Brent, which we'll talk about in a second. Interestingly, education absolutely spiked up. I'm not sure why education has spiked up, but if we look at the bottom, we can see all goods at minus 0.3% for month on month, with services plus 0.4%. Now, I think this bears talking about, okay, because effectively, the price of goods has been very much affected by supply chain. We've had COVID, we've had supply chain shocks, we've had utilities feed into the supply chain. And my understanding, after reading some other articles and doing some analysis, is we've probably got quite a lot of retailers who were struggling to be able to understand their forward ordering habits. So may well have a lot more stock in their warehouses, on their books, than they used to. So we're seeing a combined effect of utilities falling out, petrol falling out over the last year, not over the last couple of months, right? And potential retailers dropping prices on goods to be able to sell them because they've got a glut of stock. Now, with interest rates high, if things are biting, then of course people are going to be spending less. That's the whole point of tightening interest rates and the QT process, to get people to be spending less. So if there's a glut of goods, people are spending less, they're going to be buying less. Retailers are naturally going to have to drop their prices to get stuff out. So I think this is encouraging. We still have services, right? Services inflation month on month is 0.4%. And of course, in the UK, we are primarily service-based as an economy. So 0.4% annualized is, what's that, just under 5%. Something that we're going to need to follow over the next few months is that wage growth. Because wage growth, particularly in the private sector, if we're seeing that, if it continues to be strong wage growth, that's going to push up the services inflation. And again, we could see that secondary inflation effect over the next 1 to 6 months. So services is going to be interesting to watch. And if we look at the CPIH core, okay, so this is with all the volatile stuff stripped out, we've actually only gone down from 5.9 to 5.6. So huge drop off in headline CPI and headline CPIH. Core, 0.3% drop. Not a massive amount, especially when you look in comparison of percentage drops, okay? What this is saying is that we've seen this big drop because of the volatile utilities dropping out, okay? And if I come down here, don't worry too much about that. Well, in fact, that is the cost of energy prices over the last sort of two years or so dropping off. You see this little tick down we got at the bottom here. That's between last month and this month. So that's why my prediction was wrong, because I forgot the energy price cap was coming down. So we're seeing that energy price cap come down again. But I want to just go, sorry, I know I'm scrolling quickly here. There is one I want to really show you for this, which is this graph here, okay? So this is the owner-occupier housing cost graph. And if you see the energy costs here, this is the blue, sort of the lighter blue, how negative that is, which offsets the entire figure. So if we strip that out, which is considerable, right, and then we look at the two main ones that we always come back to, the burgundy and the sort of light pucey green. Burgundy is owner-occupier housing costs. The puce green is the rental costs. We can see how much these are still going up. So next month, when this falls out, right, because we're not going to see this big drop next month, and these continue on their upward trajectory, okay, what is going to be happening? This is going to continue to put stress on people's affordabilities, particularly, well, I would say for everybody. So yes, by the way, it's great news that this has dropped out. Even myself has been struggling with utility costs. You know, I know it's all relative, but those utility costs last winter were horrific, right? We went into that last winter and they were spiking. That was not good. So this is good news for everybody that we're now dropping these utility costs. But we're not out of it yet in terms of costs for rent. Maybe we've peaked on rent, but we'll see. But more importantly is that lag with the mortgage costs. So that's something that we need to take into consideration. The only other thing I wanted to talk about on today was the cost of transport, okay? Because we talk quite a lot about cost of rent, that feeding into supply chain. We've been looking at this cost of motor fuels, which is this sort of one that really dipped down and is coming back up. And don't forget, it's dipped down, right, hugely, because all of these figures are a trailing 12-month figure. It's not just a snapshot in time. It's looking at where we are relative to this time 12 months ago. So last summer, petrol, diesel went up massively. We then saw this big drop off. So when we saw the last big drop off inflation a few months ago, it's because, you know, this summer 22's oil prices fell out the data. We've now been seeing it come back up. Okay, something that has come down that is completely offsetting this apparently is the price of second-hand cars. So when we look at the narrative here, the largest contributing downward effect came from the purchase of used cars, where prices fell 3% between September and October. Okay, so again, I just want to clarify this in terms of reality for the actual cost to people. Now, everybody who is traveling around has to put diesel or petrol in their car to do it, unless, of course, you're an electric car, but then we've obviously got the price of electricity. So everybody's driving diesel electric car, right, is going to have to put it through to go to work, to go shopping, all of this sort of stuff. Not everybody has to be out there buying secondhand cars. again, it's indicative. Now, I can't remember if we covered this much, but one of the reasons the price of secondhand cars going up so much was the whole automotive industry went into a bit of meltdown with a lack of supply chain for chips, effectively semiconductor chips. Massive supply shock. Prices went through the roof. Prices of secondhand cars went through the roof because the value is being retained. That now seems to be over. Price of secondhand cars is coming down. So if you're out looking for a secondhand car, there's probably there's an increased supply for less demand. Okay, so people are buying less. So we are seeing this in this basket of goods that go into the basket, which is offsetting the rise in motor fuels. And I think that's skewing artificially, right, what is actually happening with that rise in motor fuels. So again, this is probably going to drop out soon. So look, let's just sum this up of where I think we are. We were expecting this massive drop. It's bigger than I thought, which is a good thing if you spend a lot on gas and electricity, by the way. We are going into a period for the next 3 months of quite level in terms of movement over 12-month trailing. And my suspicion is we're probably going to see some secondary inflation over the next 3, 4, 5 months, maybe 2 to 4 months, exactly like we've seen in the States. Okay, what is this doing to swap rates? Let's have a look at the swap rate chart. Now, our SONIA swap 5-year now current is 5.126%. Don't forget, this is published overnight, so this doesn't cater for today, so this might well come down. So we are still, however, just to explain how the swap rate works, the SONIA swap rate, this is how the markets are pricing the average interest rate in the time period. So it could be that they think it's going to go up still from 5.25 to 5.5, 5.6, and then it might drop down, it might settle somewhere, but in a 5-year period, they feel it's going to average 4.126%. I'll be interested to see what it looks like tomorrow, but we're still not seeing, massive drops in interest rates on the swap rate. Yes, it's coming down. Yes, this is going to feed into mortgage rates, but it's always going to find a level. And as I keep saying, there are more people, 1.6 million over the next year and a half, who are coming off their cheap debt and going on to higher interest rates. Even if it's less higher than it was 6 months ago, it's still much higher than people are on now. So that's going to keep that affordability going. So do I think this is going to have a drastic effect to the property market and the narrative we've been talking about? No, absolutely not. For me, it's narrative, as I've been saying for the last 4, 5, 6 months. It's longer, more extended, shallower correction in the property market with higher, more persistent interest rates. The only way we're going to see that change, right, is if inflation does suddenly drop down and goes way below target, probably deflationary. At that point, the interest rates probably come down quite quickly. But the narrative that came from the bank last week was they're expecting the interest rate to stay longer for higher. They will be worried about secondary inflation. They'll be worried about the core inflation, which has come down much less than that headline inflation. They'll be worried about the strong wage growth, which we are still seeing. And don't forget, right, we are now seeing wage growth considerably above inflation. What's that going to do to supply demand? We are also now seeing interest rates now above inflation. For the first time, isn't it? Probably for the first time in decades, real interest rates are now positive. That is something that is going to be quite interesting when we look around the world. Global economy, effects on bond yields, effects on commercial property prices, effects on persistent property prices if interest rates stay positive for quite a long time. This is a new scenario we've seen. So there we go. There's my analysis on where we are. I do not suddenly think, like loads of other people, that we've now hit the bottom, interest rates will get slashed, and the property market is going to bounce in 2024. I still think it's business as usual. Right, let's go and see what the questions are. Give me a thumbs up if that was of interest for you. Let's see what people have been saying, and if I can go through any questions. Robert, I'm going to put this on the broadcast. I hope you don't mind. Lots of people are on good money struggling to cope with cost of living. We've got a combined income of over 100,000 and we're skint. I think this is absolutely true and indicative. Especially we haven't even talked for a long time about the stealth tax grab that's going on right now. Because don't forget, everybody is now, or not everybody, many people are being dragged into higher income tax brackets with the freeze of the income tax brackets. So all that nominal wage growth that's going on, right? All the people that trickling up into higher tax brackets, that is a big stealth tax that's also happening. So we have to understand what our net disposable income is after tax, after our costs, after our interest costs on or our mortgage or our rental payments, what's actually left at the end. Doesn't matter if things are going down in price if nobody's actually got any affordability. This is why we talk about affordability all of the time. Okay. In fact, look at that vector story time. I'm just going to put that on, almost like your mind thought exactly like mine, Vector. Affordability is still a hurdle for average individuals. The banks are not willing to lend as much as pre-2021, and they're not. And don't forget, the banks are also stress testing way higher right now. The last time I looked at it, banks are stress testing 8-9% on interest rates for people, which means they're going to be lending lower to people, which means that gravity, right? And this is why I still think we're in for a longer property market correction than many people still think, because ultimately it's all about what people can afford to borrow. So we've got the double whammy of higher interest rates. We've also got the double whammy, first double whammy, higher interest rates. The second is that banks will lend less to people based on stress testing. Okay. So, previously they were stress testing 4 or 5%, then it went up to sort of, 6-7%. I think now we're at 8-9% sort of region that banks are stress testing. So it doesn't matter what's going on. If banks won't lend, it's exactly what the credit crunch was in 2008. If banks won't lend, people can't borrow, they can't buy, they can't force property prices up, right? We've got some way until we're seeing a reversal in that market, is my personal view. I'd love to hear what your thoughts are, by the way, team. I always like to ask this, with this sort of big drop in inflation, do you think that's going to have any difference on where we trough in the property market? Do you think it's going to have any difference on how we recover in the property market? It might be worth refreshing that piece of data we saw from Savills. I just got that up here that we went through earlier this week, where they're talking about property market going up to 5% growth in 2026 and 6.5% in 2027. Now, if we remember the assumptions on that, because I did walk through those assumptions, if I can find that piece of analysis. There we go. The assumptions were for that interest rates, or Bank of England base rate, not interest rates, Bank of England base rate would be hitting sub 2% again by 2027. I think that's bullish. I think that's really bullish. Look, if we are in interest rates like that, yes, of course. I think property prices are going to be recovering. I just think it's bullish, even with the inflation where it is. Okay, cool. Let's see what other questions we've got. AM, sorry, you said you just joined. What's the gist? Jane, what's the gist? Is the title of the video deliberately misleading? It wasn't deliberately misleading, AM. I will just answer that question. It was a little tongue-in-cheek rather than deliberately misleading. And actually, we can take the title of the video in whatever context we want. So property market to explode could be to go up, could be to come down. I think what we'll see, as ever, is a lot of... Remember, I try and be neutral and completely objective on this channel. I am a property investor. Ultimately, I have a vested interest in property and would like to see prices go up. Long term, probably in the short term, I'd like to see them correct, because now for me is a period of accumulation. I started buying again earlier this year, and there have been fantastic property deals that we've been finding and have been able to negotiate. By the way, all of those ones that I'm buying are really not just a standard bricks and mortar single let style property. They're all more complex than that. And when you start weaving in commercial valuations, the big correction that's happened in the market is in the commercial space. So when you look at property based on a commercial valuation, just like the bonds, with interest rates and yields going up, values are going down. So there's lots of REITs, real estate investment trusts, who have massive portfolios of commercial property, in prime areas. They're really struggling right now because the values of those properties are going down, which is an opportunity for somebody, right? And for me, as an agile investor, taking the opportunity and accumulating in this phase, so not just buying resi sort of stuff, buying commercial or things we can value on a commercial basis, I've seen a great opportunity. So actually, slightly vested interests, quite enjoying this turbulent market, because if you can accumulate now over the next 1, 2, 3 years, clearly, just as Keith talks about earlier, the cycle will repeat itself, and at some point we will be going back up again. So it's like everything. Those who can accumulate, at the right time, are those who will benefit when the cycle reverses and the cycle changes, and it will change. And my aim is to be completely objective with the market. I'm not perma bull who just thinks property carries on going up forever and doubles every 10 years. That's absolute BS, right? Do not believe that. It's one of the most dangerous things that people put out into the market. I'm also not a bear who wants to get YouTube clicks by saying we're going to see a 35% crash. I do apologize. Sometimes I put out the headline on the thumbnail because we do have to get eyes on the actual content. And when there's people talking about 35% nominal price corrections, I think it's important to actually address those and actually look at the reality and see, are we going to see this or not? I've always said I don't believe we're going to see 35% peak to trough price drops. I personally suspect we're going to be more in the 15 to 20% peak to trough over a 3-year period is where my gut feeling is. Now, it might, that might change. It might not be that much. It all depends where interest rates end up. So there we go. Tongue-in-cheek was the best choice of words. Yes, I am. Tongue-in-cheek. Good. Talking about that, I always say this. By the way, I've just been, one of the reasons there might be some slight fuzziness around the camera is I've got some software or some hardware around my camera. It's been recording a brand new training video, which I'll be putting out hopefully beginning of next week. That I'll send everybody a link to about how to actually invest in the current market. If you are looking to invest in the current market, I absolutely recommend you download this white paper that I put together earlier this year. Everything in it still stands true, and it says the sort of deals that I think as property investors you should be looking at if you want to accumulate right now, how to do it, and sort of what the criteria are. So that's robstuartglobal.com/white-paper, free ebook. It's about a 40-minute read. You'll also find that, as well as various other links in the description to this video. I'll just post that on the comments after we get off the live so you can find it more easily. Okay, team, I did want to be short today. We're already half an hour in. If anybody's got any more questions or thoughts or comments over today's CPI or inflation data, let me know. Just to confirm my summary there, big drop, bigger than thought. It's all headline, it's all utilities based, which I think for everybody is good. I think it's one part of that afford. As we go into the winter, the fact that utilities have dropped so significantly since last year is a good thing. And I don't know if it's just me because I've relocated down south. It feels like we're having a very mild start to, end to the autumn as we go into, into winter. It seems very mild so far. And I think that's also going to have probably a forward downward pressure on utility costs. We, of course, have tinderbox in Russia, Ukraine. We have tinderbox in the Middle East. All of these things could put in those black swan events. Something else could be a black swan event that completely changes the course once again, because there is fragility in the system. But for now, utilities coming down is a good thing, but let's not kid ourselves, right? Core inflation has come down 0.3%. So when we strip all of that out, core inflation has come down 0.3%. A lot of that coming from, by the looks of it, secondhand cars coming down. Goods, which I suspect there's probably a glut of goods sitting in warehouses or on shelves right now, and retailers are, now the supply chain issues have eased somewhat, have a glut of goods that they're probably looking to get rid of. I'd imagine we'd see some good sales going into Black Friday and Christmas run up. So it'd be interesting to see the sort of Christmas activity we see. And then as we go into December, January, February next year, I would not be surprised if we saw some secondary inflation come in, which of course then just pushes everything out to the right again, rather than everybody getting excited and thinking interest rates are going to go down, property prices are going to bounce. That's my overall. If there's any more thoughts to that, let me know. If that was useful, give me a thumbs up. We'll be going live again next week to look at the next set of data as it comes out. I'll also probably give you an update on one of the property projects we're doing as we're not coming to the end. We're coming through some of the heavy lifting of the strip out and redo. So I'll just give you an update on that. Hope that was useful, team. It's been an absolute pleasure as always. Have a great end to the week. I know it's only Wednesday, but it feels like it's been a long one already, and I'll see you next week. Have a good one.